Welcome to Multifamily Finance 101 by James Ng, Senior Director, Old Capital Lending here in Plano, Texas. So you've heard it's a good idea to invest in multifamily and you want to figure out how to get it financed. Well, you have three questions that you're going to need to answer. First question is the property stabilized? Are you going to focus on a yield play or are you going to focus on value play? Second question is, what is your experience with multifamily real estate? So anything 5 units and above, what is your experience? Have you bought a couple before, or are you a new investor? Third question is, what is your net worth and liquidity? So what financial backing do you have today before you buy this property, and anybody signing along with you as guarantors? So let's jump into these three questions. So first question, is the property stabilized? So are you acquiring a property that is 90% occupied or over 90% occupied for the past 90 days? There's no major rehab needed on the property and the historical financials are clean in that they are accurate and have been reported correctly. Or are you a little bit more aggressive looking at a value play where the asset is distressed and performing below market and needs significant updates to be brought up to a market ready condition and is suffering from possibly low occupancy and thus low NOI? So second question is, what is your multifamily experience? Are you experienced with at least 24 months of multifamily ownership and have multiple properties throughout DFW, or are you a new investor who has no experience but a lot of enthusiasm and have heard that multifamily investing can be very profitable? So what is your experience is the second question. And then the third and final question is, what is your net worth and liquidity? So typically banks are going to want to see a net worth equal to or greater than the loan amount. So if you want $1 million loan, then your net worth or the combination of all your key principals in the loan are going to have to be greater than $1 million. And in that same example, in terms of liquidity, they are going to want to see at least $100,000 of post-close liquidity. So after the down payment, how much do you still have in cash or marketable securities, not in retirement accounts? And that typically will have to be shown at close. So let's walk through a couple scenarios here after answering these three questions. So assuming you meet the net worth and liquidity requirements, if you are looking at acquiring a stabilized property and you are an experienced operator, you qualify for non-recourse loans, which could be agency, such as Fannie Mae or Freddie Mac, or CMBS. However, in the other three scenarios laid out here, you would work with a local or regional bank and acquire a recourse loan. So stabilized property, new investor; non-stabilized with an experienced or new investor is going to go recourse loan with the bank. So typically on a non-recourse loan, it is 75 to 80% loan to cost, 5 or 10-year term, and then the interest rate will be fixed and the amortization will be 30 years. And you will have no personal guarantee of any loan shortfalls. On a recourse loan, however, it will be lower leverage, so 70 to 75% loan to cost, 5-year term, 20 or 25-year amortization depending on the age of the property, and you will personally guarantee any loan shortfalls. So that's it for Multifamily 101. If you have any questions, feel free to reach out at jeng@oldcapitallending.com or 214-300-5035.